focus on the entire pharmaceutical space and talk about Strides Pharma. It reported what was a good set of Q4 numbers. The margins have improved to a multi-quarter high. It also reduced its net debt by over 300 odd crores in FY24. To discuss this, we have with us Arun Kumar, the Executive Chairman, Strides Pharma Science, joining in now. Mr. Kumar, welcome to the show and good to see you in as always. I wanted to start by talking about the margin improvement that the company has seen consistently. Margins now stand at around 20-odd%. What led to this improvement? Was it the US business contributing or maybe operational efficiency? And secondly, what are you guiding for in FY25?
Thank you, Ekta, for having us. Yeah, it's been a good year for Strides in terms of its reset strategy. We completed everything that we have guided for in terms of margin expansion. So the US did contribute a large part of our margin expansion, but so also did other markets. And what is most pleasing has been that we have contained costs for the last 3 years at the same absolute dollar numbers. So that allowed us to focus on OpEx leverage and free cash. Pleasing also was that almost 90% of our EBITDA is converted to free cash generation. That led to debt reduction, and we'll continue focusing on efficiency and a steady growth in our business led by the regulated markets.
So you did briefly allude to the US. You hit about $250 million for the year. Quarterly revenue was flattish. Just wanted your thoughts on, the road to $285 to $300 million and eventually $400 million. By when do you get there? And margins, what are they likely to be going forward? Will they, continue at that 20% plus mark?
Well, it's been, we were at single digits, so we've taken 8 quarters to get to 20%, and we'll continue slowly moving up that. Our target is to get to about 22% as our EBITDA margin, which used to be our all-time highs. So that's our focus. To your point with the US, historically, Strides has a very strong flu season-led business. This year, it was not the case. The flu season was almost not there in the US, but we had some great product launches, new products, especially generic Suprep. We are market leaders on that product today. So that made up for some of the loss of sales in Q1. So actually, if you look at comparative year, we've grown about 10% on the Q-on-Q or on Y-on-Y. And based on recent approvals, including Sucralfate, which is our first Indian company to get a product in a very complex generic, we are very, very confident of getting to that 285 to 300 mark in terms of sales in the US.
Okay, all right. You're confident about that. Can you just give us a sense in terms of, the base business in the US? Is that seeing pricing pressure? I know that the flu season wasn't as good this time, but what about the base business as well as new launches? What can you guide us for?
So, Ekta, we have spoken about this earlier. Our commentary remains the same. We have this huge basket of approved products in the US, which we are not. So we have the luxury of approved products that we can launch at any time. We do not accept significant price challenge on our products. And when we do, we just let go of a product because we have this wide range of products that we can make up for sales. So for a long, long time, we've been saying that we are, to a very large extent, immune to pricing pressures. We do see in specific products and portfolio pricing pressures, but we continue to keep market share if the pricing is right. And if not, we are happy to let it go.
Right. What about debt? Net debt has reduced over the last 1 year. What's your plan on reducing it further, or are you comfortable at these levels?
Well, we are very comfortable at 2.7, but we have guided a further reduction of 500 crores in the financial year. So if we want to bring it under 2, that would be a very comfortable position for us to be long term, and that's our goal.
Okay, all right, fair enough. Give us a sense in terms of the OneSource listing now. Where exactly does it stand in terms of a process? When do you expect it to list? And what is the profitability of the business?
Right, so OneSource has received all necessary regulatory approvals, including the SEBI approval a couple of days ago. So we are now ready to start the NCLT filing. We expect to be filing the NCLT in the next week or so. And then it's a typical 9 to 12 month period from NCLT approvals to listing. We've guided the business to be in the range of $165 to $175 million with an EBIT of in the 30s. So we are very delighted that now we've got behind the regulatory hurdles, and now we are all set to get into a listing of OneSource, which then will make us India's first spec farm CDMO. The target there is to focus 30-35% EBITDA business.
So by when? What are the timelines that we're talking about here?
So we got all approvals last week, all regulatory approvals, including SEBI. We can now file the NCLT as early as next week. And then it typically takes between 8 to 12 months, including the court process and the listing.
All right. Thanks a lot for joining in and giving us your views on the year as it looks ahead. $285 to $300 million in the US business, looking at an eventual margin target of close to around 22% with a debt reduction of almost 500 crores during this year. And maybe soon we will have the listed pet care business as well. Take a short break. On the other side, we have Sudeep Shah of SBI Securities joining in with some trading strategies to discuss the market.